Another perspective. So let's get one on inflation and ETFs. Joining us now is Alexi Panagiotakopoulos. He's a partner and chief investment officer in Fundamental Income. He runs the Net Lease Corporate Real Estate ETF. This is a real estate investment vehicle that throws off a 4% yield. Now, Alexi, explain to us how this ETF works and why a triple net lease, well, first of all, what a triple net lease is and why that's an advantage in an inflationary environment.
Well, look, I mean, frankly, we started this ETF because everything that Bob, Kevin, and Scott are mentioning. This is a boring vanilla strategy that has performed for many years. You look at some of our top holdings like Realty Income and WP Carey, which have been around since the 90s and have averaged 12 to 15% annualized returns and dividend growth of 4 to 5%. In a market that's sideways with interest rates sub 2% and not many places to hide. Preferreds yielding, mid fours, high yield debt yielding mid threes. We wanted to create an index that was total return focused and frankly, something that most people own in their portfolio already. All 25 of these names in the index that we've created with NASDAQ exist in the VNQ. However, we've highlighted 25 names that all do the same thing. All these companies own single tenant freestanding real estate. And it's really the real estate of America. It's all around us. It's the gyms that we go to, the convenience stores, the pharmacies, the grocery stores, it's things people need. But we call this the gold rush theory. In the old days, everyone rushed to pick gold. But the people that are still standing today are the John Deeres, the people providing the equipment to generate revenue and EBITDA. And so all 25 of these companies focus on triple net leases where the tenant actually pays property taxes, property insurance, and property maintenance. And so going into the investment, the underlying REIT already knows what their return is going to be, and they're not subject to inflationary pressure like rising labor costs. We don't look at corporate profits because, frankly, rent is senior to an EBITDA calculation.
So I think to explain this simply, just somewhat what you said, the fact that the tenant pays taxes, fees, and maintenance costs sort of insulates you from inflation here, because if there's an inflation here in certain things, the tenant's going to essentially pay that. So you get a sort of bond-like income with an equity upside, right?
That's right. I mean, at the end of the day, these are 25 equity companies. They're all NYSE and NASDAQ traded. And, when you think about a triple net lease, they're not only long-term leases with an average of 12 years, but they also have built-in rent escalators of roughly 2%. Kevin mentioned earlier trying to target fundamental investments that have 8 to 9% returns. And frankly, if you look at underlying holdings of these 25 companies, these REITs are able to buy household names like Home Depot properties and Amazon properties and 7-Eleven for cap rates somewhere between 4 and 7%, with somewhere between 1 and 2% of annualized growth, which compounds over time. And so, frankly, these REITs are benefiting from lower interest rates because you're not really investing in a $10 billion portfolio today. It's almost like a laddered corporate bond portfolio where you've been buying into this over time with various interest rate environments, and they're going to rise when inflation rises.
Yeah. Now, I'm looking at your largest holdings here, National Retail Properties, WP Carey, Realty Income, Stag Industrial, Store Capital. These are all, you characterize them as mission-critical assets, essentially. They own industrial spaces, they own warehouses, they own distribution centers, freestanding real estate, essentially, that's very important to the operations of these various companies, right?
That's right. And really, that's what you're investing in. This is akin to corporate credit and more detailed and nuanced. It's contract risk. What is most important to an underlying company as dividends dwindle? And that is their real estate, because we focus on, and these REITs focus on real estate that is imperative to a company's ability to generate revenue and EBITDA. I mean, Amazon can't generate revenue without a distribution center. Starbucks can't sell a cup of coffee without a drive-through. And you go through, a lot of these are insulated from e-commerce. And frankly, e-commerce, lo and behold, actually requires more real estate than a lot of traditional brick and mortar retail.
Yeah, it's a good point here. Kevin, your thoughts on REITs? This sounds like a very interesting idea here. Essentially, you're going to pass on largely pass on any inflation costs to the tenant at this point. 4% yield seems pretty good. Is there something wrong with the picture here, or is there another way to look at this?
No, I think there is a change of use, though. I'll give you an example. In a lot of my private companies where I sell goods and services, Bed Bath & Beyond closed 200 stores. very desirable locations. We didn't lose any sales because they basically went direct to consumer in those suburbs. But those buildings themselves are going to get converted into climate-controlled pick and pack storage for anybody that wants to deliver within 4 hours to the people in these dense areas in rural areas as well. So what is occurring in that process, and I'm looking at these deals myself, is maybe the cap rate pre the closing of the store was 5.5%, maybe 6%. It might gap up to maybe 6.5%, 7% during the capex required to convert it into a climate-controlled storage pick and pack robotic facility. But it'll go right back down to a 4.5 cap. So there's a little volatility in real estate pricing during this conversion period. Same is going to happen with movie theaters. There's some other use cases that will change. 1,200 square foot strip malls may get some change there. And I'm trying to figure that out because real estate's always been a big holding for me, around 31% of our operating company's portfolio. But we have definitely trimmed back on office, AAA office even, and have started to be more strategic in where we reinvested. And we're looking cloud kitchens, for example, things like that. So real estate's here forever. I definitely agree with that statement, but it's the way it's being used is changed as a result of consumer purchase behavior changes.
What about that, Alexi? Are there use changes that you're dealing with, or it's the fact that, as you describe them, these are mission critical, sort of insulate them from use changes?
No, Kevin's absolutely right. There's definitely going to be some volatility. If you look at data, public traded real estate has outperformed privately traded real estate probably 15 of 17 years. And the key here is not only do you get the current return, but you also own the asset. So in the event that Bed Bath & Beyond does close stores, like Kevin mentioned, they were repurposed. They were repurposed into longer-term leases with secondary use, unlike corporate credit where, if you own a high-yield bond and Bed Bath & Beyond goes away, your best case is your recovery, which historically has been less than 50% to bondholders. And so in this scenario, your recoveries can push 70, 80%, but your cash flow stream is still consistent. So in a period of volatility where you might see mid-cap value trading with dividends around 1%, 2%, there's going to be volatility in mid-cap value. In our eyes and in our own portfolios, this is a mid-cap value exposure. This is not just traditional real estate. And that's why we launched this with NASDAQ. It's the first and only of its kind. And it shines a spotlight on a new way of investing. The investing in fixed income of old, like Kevin and Scott both have addressed, is gone. But in an 80-20 portfolio, you do need some current income. And in this fact, income and growth can offset your duration. And this is a new way to invest in fixed income.
Scott, is this a reasonable alternative to owning bonds? It seems 4% is pretty good. What attracts me is this mission-critical idea. It doesn't seem like a lot of places are going to close or have a use change that are mission-critical.
Sure. No, it's a very valid use, a very valid capital allocation for people. I would just kind of use the same sort of warning as with things like high yield and converts and preferreds and loans. And, look, this should not be tourist money. Like, these are specialized and niche asset classes, and with a 4% yield is going to come a similar kind of risk. There is no free kind of lunch out there, and so I would just say, listen, if we're going to be building these portfolios of these kind of higher yielding types of instruments, let's not fool ourselves in thinking that yield is going to be there all the time. It's going to be a completely smooth ride. These things can have very sharp drawdowns, and so they have a very strong use case, but they need to be risk managed. They need to be actively risk managed.
Yeah. And Alexi, just one final point here. REITs were a big market leader last year, one of the big sectors. They're laggard this year. Is there a particular reason for that?
Yeah, I mean, there tends to be, fund flow issues and a reaction to rising interest rates. But again, this is like a laddered corporate bond portfolio. You're not buying, $200 billion of bonds in a low rate environment and then subject to rising rates. At the end of the day, these REITs were built over the last 20 years. And over time, your income factor and your growth are going to push down duration, and you're going to grow out of this because when inflation occurs, cap rates also move. And these companies are also beneficiaries with very fixed cost models. And so as cap rates jump from 5 or 6 back to 7 or 8, where they have been historically, they're going to capture additional yield. And one thing that's really important about these sector-specific REITs is they have dividend payout ratios of about 80%. And so the dividend yield on these is not a yield trap. These are fundamentally built to reinvest cash flows. And by reinvesting, you're growing out of potential credit losses or inflationary pressures of the past. And so that yield is really
Yeah.
generational from the reinvestment.